Good morning, good evening, good afternoon to everyone here. I am Alex. I help lead business development at Sushi, and we are bringing you some very tasty tidbits of knowledge with our panels today. So we will be first starting off with our first panel where we have a handful of panelists who will be discussing trends in DeFi. So hope you all enjoy. I guess we can start off with some introductions. I'll kick it over to our illustrious head chef, Jared Gray, who can introduce himself.
Hey, everybody. Yeah, really excited for this stuff. It's been something the team's been planning. Great to have all of you join us in helping educate people about all of our protocols and spread the good news of DeFi. I think it's more important than ever. I'm Jared. I've been the head chef at Sushi since October of last year after a governance vote. Really excited for all the work we're doing here. Excited for a lot of the partnerships we have with most of you and the ones in the works as well. Yeah, excited to see where this goes.
Cool. We also have Sarang Parikh, who is one of the core devs at Sushi. Would you like to introduce yourself?
Hello. Yeah, hi everyone. I'm Sarang. I basically lead dev and smart contracts at Sushi. And yeah, I'm pretty excited about the panel.
Great. Devin, would you like to go?
Everyone, Devin here, one of the co-founders of GameSwap and the COO. And essentially what we're doing is enabling people to borrow liquidity from various AMMs and pools, which we're hoping will help scale DeFi TVL by compensating LPs for some of the IL or volatility risks that they're assuming.
Amazing. We also have Seraphim from Euler.
Hey guys, how's it going? Yeah, I'm Meta Risk at Euler. We're lending protocol in Ethereum. So far, we are probably one of the largest two-way, one of the largest on-chain markets for trading OSDs. We have CB, Stake ETH, RETH coming up actually literally today. And yeah, just happy to discuss all sorts of things about DeFi.
Amazing, thank you. And we Mohawk from Claystack. Oh, you are muted.
Okay, sorry about that. Hi all. I'm Mohak. I'm the founder of Claystack, which is a liquid staking protocol to unlock liquidity of staked assets. We're building a protocol which is going to be well decentralized and scalable. And along with the core protocol, we are building a suite of products that are going to aid in the advancement of liquid staking.
Great. And Sammy from New Order and Redacted.
Hey guys, yeah. My name's Sammy, one of the co-founders at Redacted, also helping out at a couple different places like New Order, essentially building, like a liquidity toolkit, like Hidden Hand and Pyrex and different DeFi tooling that, dApps and different players in the ecosystem can plug in to, increase their liquidity.
Awesome. And we also have Halko from DopeX.
Hello. Pleased to meet you. So I'm Halko. I'm mostly helping the DopeX protocol as well as the Jones protocol. So in general, options and the structure solutions centered around the Arbitrum blockchain. So I'm also very, very happy to be here with all the guys. Thanks.
Great. And last but not least, my man, Jason Ma, how are you doing?
Very well, thanks. Hey, it's Jason. I lead DeFi at Axeler. Axeler delivers cross-chain communication for Web3. Our infrastructure allows users to interact with any asset or application on any chain in a single click.
Amazing. Great. Well, thank you all for being here. I know our audience and people that will be watching this video later on are super excited to hear from all of you and your incredibly large brains about some trends in DeFi and kind of what we can start to expect moving into the future. So, first question, I think a lot of people are thinking about 2022 was quite a transformational year for decentralized finance. And so heading into 2023, we have many different headwinds and tailwinds kind of going at the same time. So what do you see as some of the biggest challenges facing our industry and DeFi in general, and how can they be addressed? Jared, would you like to kick it off? And then we have a lot of people here, so we can just kind of free form it for a little bit if that works for people.
Sure. And I'm gonna, I think, just kind of keep my answers kind of constrained so we can hear from everyone else on this panel, because I want to hear what they have to say more than I want to hear myself talk. So I think the way I think about this question is from like the business administration level, which may be a little bit different than the rest of the panelists, because they're building protocols and stuff like that, trying to increase liquidity, et cetera. And it's really just kind of my goal, or my view, is the regulatory pressures, how that applies to our industry, how we can navigate it, what we need to do in each one of our locales. We're all distributed across the globe, and each one of them presents kind of at times siloed jurisdictional risk, and then we have globally distributed risk that we have to take into account. And so I think about that stuff for Sushi, how it applies directly, and then kind of across the board at a macro level for our industry at a whole. And it's really, I think, comes down to education. Since I've been in this industry and going on like almost 8 years, it just every cycle, every year increases the requirement for us as builders and as business administrators or protocol administrators, however we want to label ourselves, to continue to educate people so that they become advocates, help the regulators in the US, at the representative level, so that we have people in place that understand the technology, how it empowers people, and that it's not this existential threat. It's an empowerment tool, and it's to build bridges globally. We don't want to, create moats for ourselves in our areas. And so that's how I think about it. I think we have kind of a requirement to continue to educate people at all levels, so that the regulatory environment becomes or continues to improve for us. I think Seraphim had a answer.
Oh, it's funny we discussed regulations. It's funny we discussed moving to Dubai just before this call, so that just tells you about the times nowadays. But just on a certain point, a couple of points apart from regulations is indeed growing liquidity as a product is always very hard. That's one of the hardest things to do. Like some guys are exceptionally good at this. Like if you look at Frax, they've been completely geniuses about the Frax, about the curve bribes, really. But not everybody has that luxury of being able to bribe people to build liquidity. So how exactly we're going to build liquidity is a crucial part, especially for integrations and stuff, which leads to oracles. I think after spending a lot of time with devs in Denver, it's becoming clear that just integrations are very difficult without oracles, and Chainlink is kind of pretty strong in this space, but there needs to be a bit more democratization of the oracles, because we can't on Euler we can't implement assets unless as collateral unless they have Chainlink or some reliable oracle, right? So there's lots of innovation is being stopped because we don't have liquidity and oracles in DeFi. That's my opinion.
Yeah, Devin. And yeah, guys, feel free to jump in too.
Yeah, no, I wanted to kind of just touch back to what Jared was saying about education being super important for these cycles, because I think as DeFi and blockchain has kind of grown, it's become more efficient, but also more complex. And so I think we need to keep building on that complexity to have systems that are competitive with CeFi, for example, but also finding ways to abstract that complexity for the user base, right? Like making wallet experiences really seamless, providing liquidity, like democratizing that so it's available to everyone, not just a few sophisticated LPs. And so that's where I really see the future of like DeFi going, because we don't want this siloed with just like a few people who understand options or understand infrastructure really well. We want this available to everyone. So I think a big part of that is that experience being seamless, not just from a UI perspective, but understanding how these protocols operate as well.
Yeah, Suren, go for it.
Yeah, I think like one of the also emerging problem is like what happened with Oasis and like a reverse hack thingy, where they actually opened up a Pandora's box of how you can basically kind of, like take up composability and, like uh, kind of, like hold people hostage. This is also being happening right now with Iron Bank and Alpha Mora, where, the funds of users of Alpha Mora are like kind of, held hostage at like Iron Bank. Now this makes it a bit weird because like DeFi was all about like composability and how can we all work together, and then there is like this multi-sig finance which can now take over half of the stuff, right? And seconding on like what Seraphim told, like this could happen in a similar fashion with Chainlink, where we have seen apps relying on Chainlink and Chainlink just like putting off the price feed, and the entire project kind of getting wrecked, like what happened with Venus on Binance. So I think like composability is a much more bigger risk than we anticipate, and we have seen getting it like getting protocols wrecked in very unique ways, and recently what we have seen with Alpha More and Iron Bank as well. And the answer to that, in my opinion, is basically making apps in a modular fashion, which basically would limit kind of the operations that could be done. But then again, people can say, oh, okay, like then it's not as upgradable. So it is the answer is to find the right balance between the security so that people can build apps with ease on your system.
Great, thanks, Suren. Mohawk, and then Halko, feel free to jump in, and then yeah, let's keep this conversation going. I really like where we're riffing on.
Okay, my fellow panelists have raised like a lot of important points, and one of the points that I wanted to highlight was in DeFi, a majority of DeFi protocols rely just on incentives, and if you remove incentives out of the picture, a lot of DeFi protocols just cannot survive. Like we have seen, especially in the bull markets, where protocols have shot up like TVL with preserve incentives like quite a lot. And the moment you remove those incentives, no protocol saw the light of the day, or some of those protocols did not see the light of the day. So we have to build something that, like what started as a user acquisition model became the primary driving factor for the usage of that protocol. Like, for example, if you see in the Web 2, the notion is if you are using a product with, let's say, $100, you have $100, you're using a product. After using the product or service, you'll have $98. But in DeFi, the notion is that after using the protocol, you want to have $102, which is kind of crazy. So collectively, we have to work towards like building something that can last even when the incentives are not there.
I actually want to just speak to that. I'm sorry to interrupt Halko's hand raising, but agree with you completely that sustainability is at the core of any success, long-term success we see for DeFi. I think there is a sense of, dare I say, like entitlement to certain types of outcomes that I think were thrust into the industry because of the period of time that I consider it like bootstrapping, right? Like it was a startup environment in 2019, 2020 that kind of turned this, DeFi thesis and fledgling industry into what it's become. But it was a bootstrapping effect. One of the things that we spent a lot of time at Sushi is, as we near the full distribution of our supply and as a DEX, how do you incentivize LPs to take on impermanent loss risk and to commit their collateral to these pools to earn trade fees? How do you offset that? How do you incentivize them properly? And we've been working on that really since I came on in last October, and we have a model that we've been piloting out. And so I anticipate in the next few months we'll be able to present like a case study to the industry of how that sustainability model could be one of the models. Because I think it's a specific thing too for each protocol. What works at Sushi might not work, at GammaSwap. might not work at redacted, et cetera, et cetera. And so like it's a very specific use case kind of thing, which I think lends itself well to the composability that Sarang and you, Mohawk, were speaking about, building better composable modular systems from which we build on so that the interoperability and the economic incentives align with the long-term goal of sustainability within DeFi. It's just an area we've spent a lot of time, so I wanted to jump in there. I'm sorry, Halko, go ahead.
No, I fully agree. I wanted to just say that I think everyone had like similar observations, right? Which means, as you all remember, right, like during, let's say, 2021, right, it was sometimes absolutely easy to origin liquidity, which pretty much means whichever chain you were on, as soon as you were able to offer some incentives, you were seeing for TVL, right, to randomly jump to hundreds of millions, even billions, right? Billions. You could like see casually people parking billions in some like cream or other fogs, and it was pretty interesting, right? Because this all has disappeared last year, and it really was like like you play poker and then there is this time to check how your hand looks, right? And this pretty much means that protocols that were not able to actually attract users with a real way to have the liquidity providers in, and it was just like empty thing. They suddenly found out that the TVL went from like hundreds of millions or billions to very, very low amount, right? But if the protocol was actually able to provide a real service, right, to the user, to the liquidity provider, you are very able to see that not only your TVL is kind of stable, right? For many protocols, it was stable, it kept growing, etc. It was quite easy, quite interesting, because then what I think was observed, right, is during the past few months, maybe past few quarters, what people started to do, they started to build composability not on top maybe tokens, but for example, they would build composability on top of the LP positions that already were popular. They already were bringing users, and they thought, okay, I am unable most likely to compete with the specific LP pair, but maybe I can find a way to enhance it with my protocol. And I think this is something much more healthy, right? Because you are adding optionality to what already exists versus, like printing stuff out of thin air, which means tokens, going PvP for 2 months and then just disappearing, right? This thing was absolutely unsustainable. So I really think that what we observe now, I mean, you take a look at stats in DeFi Llama, it may not look too encouraging when you compare current numbers with the numbers from over a year ago. But actually, when you realize that what we have now is like really organic and is much more productive, then I think what we have now, all the building blocks that I think like have survived until now, they are much better things to build on top of. So I'm like personally find that this is actually very, very good moment place to keep building, because fundamentals I think are going to be very, very strong. So that's what I guess I wanted to add.
Jason, composability, sustainability, interoperability. Curious your thoughts there.
Yeah, for sure. I mean, this all relates to what we're discussing, right? As everyone pointed out, there's substantially less liquidity now. But another trend we're seeing is that there's going to be further liquidity fragmentation, right? Like one thing is for sure is that there's going to be more and more chains with very compelling narratives. So out of this, like, total less amount of liquidity, now it's being split into all these different ecosystems. So, we really need better technology, especially better like interoperability, composability, so we can actually like tap into these liquidity pools across chains and make better use of them. And I think really this is what's going to kind of power these next generation of DeFi applications, the ones that are able to not just like use its own liquidity, but leverage liquidity at other applications in other blockchain ecosystems.
Yeah, and I think I agree with you the most, Jason. I think like another issue that just I think like beyond sort of the issues that everyone things are the major ones like regulation and stuff. I think also from the perspective of just being a builder in DeFi, there's this constant challenge that you have to face of just trying to keep up with things. And I think one of the big things that really holds back DeFi, is actually like a huge challenge to DeFi, is this problem of just trying to keep up, right? So what ends up happening is everyone stretches themselves really thin on incentives, which were just a big discussion. When you try to grow too fast or try to keep up with the rest of the industry, you end up stretching out your incentives way too thin. And um, I think like every day you sort of see like a new chain sort of popping up. Oh, we need to be on this chain. We need to be doing this. We need to be doing that. Every day there's a new trend. And I think one of the major challenges facing DeFi is sort of like, how can protocols sort of stick to what they're doing, and just focus on that, and stay relevant, right? I think this is kind of what you were talking about, Devin, where everything seems like overly complex now, especially mainnet projects have reached a stage where they're just like way too complex to understand for the average user. I think everyone is building on top of something, whereas like when a new ecosystem pops out, it ends up being able to like distract a lot of capital and liquidity to flow off of sort of, like the hub of innovation, into things that are perhaps like, a bit simpler for people to understand. And, like there's a new DEX launching on this chain, there's new money market. These are simple. I can just park my money there. Whereas what ends up happening in DeFi is year one, year two, your roadmap ends up looking like 5 to 6 different products, a bunch of different things to maintain, and you end up sacrificing on all the things that everyone brought up. You end up sacrificing on security, you end up sacrificing on liquidity, all of these things.
Yeah, that's a great point. I think, I mean, again, a challenge at Sushi has been prioritizing, right, what we actually are, because historically it's been, like a multi-product ecosystem. The incentives maybe could have been better allocated. I think historically, it was nearly at a 9-to-1 loss, $9 spent for every dollar earned, in terms of how our emissions were spent up until really about October, September of last year. And it is challenging. And I think that one of the things I think about in terms of who we're building for right now, you're not building for the E-Trade users of the world. You're not building for the Robinhood users of the world. You're building for, I coined this term years ago, like when when we were building the last exchange, it was building by nerds for nerds. And that's kind of where we get caught in this like kind of bubble where we're all building for people that aren't quite here yet. And there's a lot of mercenary activity that goes on in these ecosystems, and it makes it even more difficult. So it lends itself to that environment that you're talking about being challenging, Sammy. And I think the way that we have to kind of bring the industry together so that protocols are helping build towards that eventuality of users like everyday people, right, is to build systems that scale, that are safe, that are secure, that we're working together as partners to present that to the industry. But then also, I think that the next leap that's going to happen is that you're going to have people that are in traditional finance that are like brokers at E-Trade or whatever. Their job is going to start to entail managing cash flows and pension funds, et cetera, leveraging DeFi protocols. That's why regulation is so important in certain jurisdictions, because you want those liquidity funnels to come from traditional finance users, but you don't want to have our technology co-opted by regulation and have it encumbered unnecessarily, or completely written off by uneducated regulators, in the US at the congressional level, right? So it's as much as an issue at the builder level as it is at the industry level. Luckily, you have people out there, I think, who are like leading that charge really well. I think we just have to keep building, keep making these systems safer, easier, and it's going to take another 5 to 10 years probably, to be honest.
Yeah, I'd say just regulation takes a lot of power away from us to implement what we want. like if you look at Coinbase, they could easily build a lot of liquidity by simply giving back some of the USDC yield. But obviously, that would be suicidal in terms of regulations, right? Any chain that wants to grow could easily do that by building some stablecoin, some native stablecoin, but they can't give back that yield, right? So yeah, that creates a lot of opportunity costs for people because of regulations.
Yeah, I guess in some ways, to take a contrarian point, maybe to you, Jared, I think like if you need a financial advisor to understand DeFi, then maybe we're not like building the right things for mass adoption, right? Because I think at least like that's how I think about it. The more middlemen that we can remove, the better. And part of that's traditional institutions, but also maybe that education gap. Like I think that's the great thing about DeFi is that all the code's available, all the docs are available, and I think that's kind of the problem. We've been trying to build these more efficient protocols, but at the expense of enabling it to be like more widely adopted. And so I think it's a hard thing to strike, and we need to kind of strike that balance. So that could be, maybe like UDB3, for example, a really complex product, like more layers being built on top to abstract that complexity away, or other approaches. But I think that's a huge thing as well. And also, like in terms of regulation, I think like CeFi makes a lot of sense to regulate, right? Like right after FTX collapsed, there was all those proof of reserves, but I mean, a lot of them didn't have cryptographic proofs, and even if they did, the sexes could just change their books after. Like DeFi, the cool thing about it is that, obviously there needs to be some enforcement, especially with fraud, but it is kind of a self-regulating industry, especially when the contracts aren't upgradable, because that contract's there, it's immutable, and maybe there's an auditing firm that can help people that are less technical to audit that contract. So that audit can't be changed, and all the liquidity and everything there is completely visible by everyone. So those tools on top to enable people to more easily do that. But I think that's the cool thing about DeFi, and one of the reasons why, there should be some protections, but we don't need the same level of regulation as like CeFi or traditional institutions.
Sure, and I agree with that. And please don't interpret when I say talk about regulations in terms of like limiting choice or freedom or whatever, because that's not what I'm intending. What I'm saying is like you have to have regulations that safeguard those freedoms, right? So like if you want to get philosophical about it, the way the federal government is in the US is not the way it was originally structured, at the constitutional level, right? So like you have to be very careful with these things, but I think that DeFi is only going to reach so many people in the current technological state and UX, the usability of it. We have to continue to improve those systems. As far as regulation is concerned, I think you have an onus ourselves, since you're challenging the status quo the way it's been for the last 100+ years, to educate regulators so that they understand that freedom and the way that we regulate ourselves can take the place of many of the regulations that exist for centralized custodians who have fiduciary duty to their depositors. And so that education becomes very important. I don't want to see DeFi in any way co-opted by regulators and molded into something that it's not intended to be. I want to see regulations kind of get out of its way, but give a framework that enables what it is at its core, so that people feel like, okay, when I go into play in the DeFi financial system, this has been structured in a way where smart contract immutability and the systems in place to prove contracts veracity have been done in a way that regulators understand and approve of that method or of that process. The same way, if you go to a bank, it's maybe a poor analogy, but the same way you go to a bank, you see an FDIC depositor in the US. Again, I'm in the US. You see an FDIC depositor button on there, that that bank has met certain charter requirements to be able to put that up there. So those types of approaches, I don't want to see people come in at the regulatory level and tell us what we should or shouldn't do, but more of a framework or process.
Yeah,
I
that's
want
the part of
Hey, just to like hop in here, I think that actually goes really well with kind of one of the next questions that we wanted to discuss. Thinking about both like the kind of like bifurcation between DeFi and TradFi or centralized exchanges. How are you all kind of viewing the role that decentralized exchange will play for the future of DeFi? For Sushi internally, we kind of have been thinking, and this has kind of been my buzzword, is we want to be the nexus of exchange, meaning that the ability to go from one chain to another and one asset from another, and really, really lowering that barrier to entry or that level of friction. So kind of curious though, given both the conversation we were just having as well as kind of some of that context, what are you all thinking about when it comes to the role that DEXs play in DeFi, and how is that different from a centralized exchange?
Yeah, I'll I'll answer this first, I guess, like adding on to what Jared said and also what Seraphim said. I think one thing that maybe holds back DEX is, I'll use Compound, like a money market, as an example here, is a lot of projects go 0 to 1, and then I think in that process of going from 1 to 2, you reach a certain limitation where you start to worry about things like regulation, you start to worry about things like incentives, and maybe you have sort of like first mover advantage, or you've been picking up a lot of good traction and whatever you put out originally. But then when you start thinking about the next group of users, there is a lot of people that are also questioning if their hedge fund can participate in DeFi, right? And then someone like Compound, who has sort of been around more than most of us on the stage, looks at it and says, okay, we're just going to put out a KYC product, right? We're just going to put out like a off-chain money market KYC product. And that is definitely not the direction that I think every project will go, but it was at the time they did it, it was kind of like the most logical next step for them, because what much more could they do to improve the product that they had at the time, other than go cross chain or do one of these things, right? So or improve the user experience in a way where they can pull in some of these funds that and can answer to some of the size that they need to sort of operate, right? And I think with DEXs, it can only serve so much with like the liquidity that they have, to the point where like you want to take that second step over, you might have to fall back onto some of the things that Web2 did well to sort of like answer that.
Okay, adding to that, I feel like DEXs will definitely, there is no other way except like DEXs to go forward. But the problem is, I don't feel very strong like towards the current model that we have, the primarily the AMM model, where most of the liquidity sits idle, and it's kind of a money loser model for most LPs except for the top trading players, unless again like it's fueled by governance incentives. Without those incentives, it cannot last. And then especially now, there are new types of assets coming, like primary liquid staked assets, and for them the current shape of DEXs again doesn't work well. And that brings my second point to what like Jared was saying before about regulation. Like I have this theory that which contradicts the FAT protocol thesis, that the base layer will extract the most fee. Now the challenge with that is like, if you see like there is no bigger public utility than DEXs, maybe like after liquid staking, but there is no other like bigger public utility. But at the same time, the problem is that everyone wants to extract the most fee at the base layer protocol itself. And I feel that in a few years from now, it's just a race to zero. If we want to build a true public utility, the base layer protocol does not have to charge any fee. The cost of running the protocol is not very high. And then all these regulated products, and I'm not saying like build non-profit companies, rather like we can build a lot of amazing products on top of these protocols, like similar to, for example, historically SMTP, HTTP. The protocols don't make any revenue, but the companies who are built on top of these protocols make a lot of fat revenues.
Yeah, just to go back to what Jared was saying really briefly, So I agree with a lot of what he was saying. Like, I think a lot of regulators don't truly understand what blockchain is and will kind of like lump FTX with what we're doing in DeFi. They're two completely separate things. So I think there should be some type of regulatory framework for DeFi, but I don't think it should be like forked over from traditional institutions. And so part of that, whether that's, people like us building in DeFi or other types of advocates, we need to help educate regulators so they can make informed decisions when looking at these two different types of kind of like industries that have formed. So yeah, that's all I wanted to add there.
Yeah, I actually disagree with Mohak on, how we are actually going towards the DEXs, because I think like we are going towards where you're gonna just call DEXs as exchanges anymore. So the reason for that is like there are been innovations where you have an AMM and their their underlying liquidity can be actively utilized. Sushi Trident is like the prime example, where at Optimism soon, and even like on other networks as well, we have been putting out strategies to kind of utilize the underlying liquidity, and we've been trying to do same with the LSDs as well, where a portion of the ETH component also goes back and contributes to the LSD protocol, making it much more capital efficient. But the idea of AMM here is like what I envision would be more of like an hybrid format where you have much more market maker liquidity coming in, and not just at the AMM side, but more on the limit order side as well. And we have seen how efficiently it kind of works with the peer-to-peer model, with like what CowSwap has and what even Sushi's limit order 0x1 is. There like numerous of examples. Like most of the small swaps, if you go on 1 inch, it's gonna route through the limit order system itself, right? So the idea here is now that because there are much more professional market making coming in, right, there are much more better ways for users to manage the money. So if the users write their own HTTP call, there are more chances that they're gonna, kind of make a mistake. So you have tools built upon it, and in the same way, there will be tools built upon DEXs, and which have been building upon. It's just like the inflection point hasn't hit yet. But there are instances like the FTX one, which is like one point where now still a lot of liquidity moved towards DEXs. But if you actually look at the inflow of the liquidity moved, it was much more to Binance and DEXs. So it wasn't like FTX collapsed and all the DEXs priced is like 10x because liquidity moved in. There was obviously an inflow, but even like other centralized exchange got much more benefit out of it. And there are things like account abstraction, which is just like, in my opinion, a fancy kind of a word for smart contract and relay, kind of together coupling in for giving users better experience for paying on like ERC20 and different different assets. That way it's gonna make it much more seamless. So I think the UX problem is gonna get solved. It's just like we are still kind of making much better Legos on the AMM side, and kind of making it an automated way, and having like proactive or a reactive method with like limit orders, and both should exist in my opinion.
Yeah, I agree with you, Sarang. I think the future is definitely where people will just see DEXs as another exchange. I think the two issues you highlighted of improvement in capital efficiency is one, but where I agree with you the most is the massive improvements to user experience. I think we vastly underestimate how the average retail user thinks, right? Like when my dad wants to trade crypto, the reason why he uses a centralized exchange is not because the rates are much better because he did tons of research, or that he understands all of the benefits of using a DEX versus a centralized exchange. It's simply because it's just easier for him to use, and he could buy most of his assets from any chain in a single place, right? And the way DEXs are today is just a terrible experience. You need to have a lot of knowledge in the industry to know where to go buy AVAX on a DEX. You're like, oh, I have to first bridge it over and then probably Trader Joe to do so. But with better cross-chain interoperability, what we're going to see is that these DEXs like Sushi, like Osmosis, will be able to offer most assets in a single place where people can buy these things in a single click with very competitive rates. And of course, some of the other implications of this is it's also going to become a more competitive space. From my perspective, I think some of the larger DEXs will survive and the smaller DEXs will probably, die off or lose market share. And, I think in addition to that, because of these bigger dexes will capture more market share, they'll probably become more of like a one-stop shop and start adding like additional products, like whether that's like perps or NFT marketplaces, all kinds of stuff, similar to what we've seen with all these big centralized exchanges.
Yeah, I think that's a very valid point. Fee compression is a very real issue to address, and I think it does concentrate liquidity from less competitive brands to the ones that establish themselves. Now, as we saw with FTX on the centralized side of the world of exchanges, anyone can come in, build a better mousetrap, have better incentives. You know, FTX, arguably one of the main reasons why they were able to scale up was the cross collateralization that was available on their exchange, which is something that, you know, I'll shill for a moment, that we're focused on in the new Sushi perps that's upcoming. You know, it'll be the first fully on-chain cross collateralized perps dex, you know, and that's something that, say, if we're going back to the network kind of discussion, and I know you know a lot about Say and the Cosmos ecosystem, Jason, but that is an area where I think you have to find, if you're coming onto the market, an area to be competitive that has yet to be capitalized on or improved to a point where you can draw in a lot of users very quickly, because the era of the incentive only driven user acquisition model, I think, is on its way out. And so, yeah, I agree that I expect the DEX landscape to become even more competitive and to consolidate further over the next, I really think, 12 to 18 months. It'll be as quickly as that.
That's really interesting that you say that. Curious about people's thoughts around, you know, OpFi. You know, we're starting to see a lot more, I guess, complex or sophisticated types of assets come on chain, such as options and more of these like synthetic assets. So kind of curious, what is everybody kind of thinking about that in regards to the innovation front, and, you know, what can we look forward to, or how are you all approaching this?
All right, raise your hand. Innovating. All right.
Yeah. So I think it's quite once again interesting thing, right? Because I already want to give also shout outs to Devin and the Gamma Scope guys as well, because they have posted a great thread yesterday on how optionality is actually embedded and hidden in the current LP model. So that's also very, very interesting. And when you think about it, like the more you start scratching the surface, you think that this thing about optionality is actually something that keeps being hidden, and it's actually kind of like a hidden building block of DeFi, right? So some people would think like, well, one thing we may need on DeFi is like pure options trading, because we have perps and other things, which is one thing. But when you think about it, is if we would take a look at the existing, we could say like real life TradFi, a lot of the derivatives trading, a lot of options trading is not the Robin Hoodish speculation where you just buy the options one day before expiry and treat it as a lotto ticket. A lot of using options is mostly based on avoiding or cutting out the risk. And this is something that DeFi has been kind of lacking, right? Because everyone was extremely risk on, like, you know, everyone say degen. But still one of those areas less explored in DeFi is actually either A, using optionality to use it as a kind of like a form of insurance, or maybe B, and that's also interesting, you can see more in our protocols starting the thinking, even if we are going to give incentives, maybe we would do this in the option-based way, so have some KPIs, have some triggers before we would even hand out incentives, right? So people start to think, what can we do? And with options, I think it's like pretty cool to see, like you go to the Arbitrum ecosystem, right, and you can see that there are many interesting things built that are built on top of options. So I guess I can, give this small plugin from the DOPEX side. But the biggest protocol on Arbitrum right now is GMX. And you would think, look, all the protocols are like separate, but no, there's, for example, a way for DOPEX and GMX to communicate with each other. And for example, you can open a digit long position on GMX. You can buy a hedge on DOPEX. You can liquidate it until the options expire. Right? It wasn't really able to do this a few years ago. Right now, you can use these DeFi building blocks and actually embed those various options of those various not options, but various ways of optionality into each other, and maybe throughout the next few months, years, we may be able to structure the DeFi products better because, as we know, everyone is thinking, people in crypto are degens, so people do not really mind shuffling around a lot of risk, right? But if we also think about some kind of like broader usage, it may be something, right, that's coming around the corner on how can we maybe take current building blocks, our current things that we use for every day, and can we, for example, transfer them together to make them more appropriate for people for whom the current DeFi may be, for example, too risky, or maybe too skewed, or maybe something else. Yeah, so that's for me.
Yeah, no, I was just gonna say, yeah, I think we've been seeing OpFi gain popularity, and I think a few people have speculated why. I think there are a few reasons, but one of the biggest ones is just infrastructure is getting better, right? Like a lot of the top options protocols are, on these L2s or on these new app chains like Cosmos, and it's because composing on mainnet, like a lot of these options, the latency was too high, or the gas costs was prohibitive in terms of building these out. So I think we're going to see more and more options protocols come out and on more and more L2s. The reason options are particularly interesting, as Halko was like alluding to, especially in crypto, is that to make options as simple as possible, you sell options by selling volatility, and then you buy options by buying volatility. And there's a lot of volatility in crypto, like even more than trade buy, and a lot of risk. And it's a way to transfer risk, and the more ways we can transfer risk, especially for people that want like more passive products, I think the more adoption we're going to get. So I really think one, especially when bridging is solved, we're going to see OpFi really take off, and it's going to allow a new wave of users to DeFi, more institutional, but also more degens and more like typical retail users as well.
Okay, one thing I want to add is, like, if you're talking about DeFi derivatives, then apart from options, we got to talk about liquid staking derivatives. And the one thing is, like, for example, what Jason was saying, that you can the experience on DEXs is terrible. People go to centralized exchanges because of its simplicity. So in other use cases, you have a choice to go to centralized providers. In staking, there is no choice. Because on a centralized platform, you don't even know if the yield is coming from actual staking, or is it like a Ponzi scheme running behind. We have all seen like what happened with recently, especially with Kraken and SEC. So there's not even a choice except like decentralized liquid staking. And the advantage is that we talk about, like, it's infinite money Legos that can be built. Like every option product can be created there, because there's the first time where the collateral itself is making yield. And not driven just by liquidity mining incentives. By the yield is real, irrespective of the market conditions. So yeah.
Amazing. Thank you all so much for kind of elucidating some of your thoughts around options. Just one final question, rapid fire, because we only have a few minutes left. What are some of the trends that we can look forward to in 2023? Obviously, a lot of things happened in 21 and 22. So, maybe a sneak peek of some alpha, or any closing thoughts that anybody has for some of the innovations coming up.
Yeah, I think we're definitely seeing an explosion of L2s, at least when you look at like pitch decks and people raising money and stuff in the background. So there'll be probably a couple of big announcements coming soon. you see a lot of OSD innovations happening, especially OSD-Fi, where people actually care about decentralization and they want to prioritize products that care about these issues rather than just capital efficiency. So it's becoming a thing. And obviously the derivative space, you see a lot of people trying to do different kind of per protocol variations. So that's I think GMX has proven that the model works. So a lot of people are trying to kind of jump on the bandwagon, but you do see innovation there. So yeah, basically derivatives, OSDs, and L2s is probably the theme of this year, in my opinion.
What old is new is old is new again kind of thing, or however the adage goes. I agree completely. Sorry, Sammy, go ahead.
No, I agree as well. I think derivatives are a big one. I think everyone's really excited about L2s, and rightfully so. I guess I'm really excited about L2s. I think a sleeper pick is the Cosmos ecosystem. I'm really excited about Cosmos this year. Been keeping really close eyes and helping out with the Bear Chain project, and just seeing the innovation that's happening around IBC, interchain security. I think it solves a lot of the problems that we're trying to solve right now with L2s and communication there. I know, Jason, you're also really tapped in with the whole Cosmos scene through Axelar. I think there is some issues still. I think not everything has to be a chain, but I guess not everything has to have a token, for what it's worth. So there's some issues around like security with the Cosmos chains, but I think, back to the first thing we were talking about, composability, interoperability, all that sort of stuff, Cosmos is like a pretty exciting place to build on for those reasons.
Yeah, I guess I'll just go off of that. I think what we're really excited for is, not L2s or just Cosmos. We're really excited for like this chain agnostic world we're going into. I think within next quarter, what we're going to see a lot more is these really natively cross-chain applications, where whether it's like cross-chain lending or cross-chain swaps, cross-chain yield aggregation, it happens in like, this kind of like seamless one-click type of way where you really don't realize what chain this project is based on, or from the user's perspective, they won't care at all. And from an Axelar standpoint, we're really proud to be like powering this kind of infrastructure that brings Cosmos and these L2s and the EVM world like closely together. So stay tuned, guys.
Yeah, I completely agree on that. And I feel the same that, the cross-chain ecosystem being built natively in the apps is like really, really kind of, like innovative. It does have a certain set of challenges on how you build it because of the asynchronicity of the, like, because people are not accustomed to asynchronous apps in, like Ethereum. But yeah, it's going to be fun to see how that plan out, and maybe like some cross-chain reentrancy bugs for the black hats to cash out. But yeah, I think that's an interesting thing. And at least at Sushi, we are like very, very cross-chain focused. And the strategy has been working well for us. Hope so it does in the future as well.
Amazing. Well, thank you all so much for being here, giving alpha, as well as just sharing your time, brain, and energy with everybody to keep learning in the DeFi space. So thank you all so much for joining. Really hoping to be working with all of you in the future as well.
Cheers, guys.
Thanks so much for having us.
Thank you.
Thanks for joining, everyone.